August 12th, 1971. Inside the Oval Office at Camp David, President Richard Nixon listens as Treasury Secretary John Connally lays out the numbers with brutal clarity. Foreign governments are demanding gold, faster than the United States can ship it out of Fort Knox. The Federal Reserve insists the dollar is still sound, still invincible, still the foundation of global commerce. Wall Street analysts laugh at gold bugs, calling them cranks, doomsayers, relic worshippers clinging to barbaric superstition. For 30 years, gold has done nothing. The price hasn't moved. Frozen at $35 per ounce by government decree since 1934. The American dollar rules the world. Paper money is king. The Bretton Woods system, architected by American power after World War II, has made currency convertibility as reliable as sunrise. What none of them know is that the fuse is already burning. In 72 hours, the world's most powerful currency will break from gold for the first time in history, and inflation will erupt with such violence that Americans will lose faith in their own money. The gold price, mocked for decades as a dead asset, a useless metal, will explode 2,400%, and Wall Street, which once laughed at gold, will learn a painful truth. People trust metal when they no longer trust governments. Act 1. The Hubris of Wall Street, the Barbaric Relic, 1960-1965. The conference room at Morgan Stanley, December 1960. Senior economist Henry Kaufman addresses a room of institutional investors, his tone dismissive, almost contemptuous. Gentlemen, the question of gold as an investment is no longer a serious one. The dollar is backed by the full faith and credit of the United States government. Gold generates no yield, no dividends, no interest. It sits in vaults doing nothing while American industry grows at 7% annually. Applause. This was not an outlier opinion. This was consensus. Wall Street in the early 1960s operated on certainties that seemed unshakable. The Bretton Woods Agreement of 1944 had established the dollar as the world's reserve currency, convertible to gold at $35 per ounce. Every other currency was pegged to the dollar. The system had survived Stalin, survived Korea, survived every challenge thrown at it. The United States held 20,000 tons of gold at Fort Knox, more than half the world's official reserves. American GDP was $543 billion in 1960, larger than the next 5 economies combined. The trade surplus was positive. Inflation was 1.5% annually. Unemployment was manageable. To Wall Street analysts schooling themselves in modern monetary theory, gold was a relic. John Maynard Keynes had called it a barbaric relic in 1924, and 40 years later, his disciples controlled every major financial institution. The gold standard, wrote economist Robert Triffin in 1960, is an anachronism. Modern economies require flexible money supplies responsive to growth. Gold is a straitjacket we no longer need. Harvard economics professors taught their students that gold had no place in modern portfolios. Yale's endowment held 0 gold. The Ford Foundation's investment committee banned precious metals as non-productive assets. Brokerage houses published research papers with titles like "Why Gold Will Never Rise Again" and "The Myth of Hard Money." These weren't fringe opinions. They were institutional doctrine. The mathematics seemed irrefutable. Since 1934, when Franklin Roosevelt had fixed gold at $35 per ounce, the metal had generated 0 return over 27 years. Meanwhile, the Dow Jones had risen from 100 to 679. Bonds paid 4% annually. Even cash in savings accounts earned 3%. Gold earned nothing. It just sat there, immobile, lifeless, mocked. Behind this confidence was a deeper assumption, that American economic supremacy was permanent, that the dollar could never fail, that government promises were as good as physical metal. At the Federal Reserve in Washington, Chairman William McChesney Martin testified before Congress in 1961 with absolute certainty. The gold standard is obsolete. We can manage the money supply better than any automatic mechanism. The dollar's convertibility to gold at $35 is guaranteed, but it's a formality. No rational actor will ever demand conversion on a large scale. The trading floors of Wall Street echoed this sentiment. Junior analysts who questioned dollar stability were dismissed as conspiracy theorists. Portfolio managers who suggested gold positions were denied promotion. The entire financial establishment had unified around a single truth. Paper money managed by experts was superior to metal hoarded by primitives. German bankers, still traumatized by Weimar hyperinflation, quietly bought gold. Swiss institutions maintained gold reserves. French President Charles de Gaulle openly questioned dollar hegemony. But Wall Street dismissed these concerns as European paranoia, the neuroses of nations that had lost wars and empires. They don't understand American power, Morgan Guaranty's chief strategist told clients in 1963. They're still thinking in pre-war terms. The United States doesn't need gold. We have the bomb, we have the economy, we have the dollar. Gold is for countries that lack credibility. The numbers appeared to support this arrogance. U.S. gold reserves in 1960, 19 through 507 tons. Foreign dollar claims, convertible at $35 per ounce, but why would anyone convert? The dollar paid interest, gold didn't. The choice seemed obvious. What Wall Street couldn't see, or refused to see, was that the system was built on a mathematical impossibility. The United States was printing more dollars than it had gold to back them. Not slightly more, exponentially more. In 1960, foreign central banks held $18.7 billion in dollar claims. The U.S. gold stock was worth $17.8 billion at $35 per ounce. The margin was thin, but manageable. By 1965, foreign dollar claims had exploded to $27.3 billion. The U.S. gold stock had fallen to $13.8 billion. The gap was widening, fast. Robert Triffin had identified the paradox in 1960. For the dollar to serve as global reserve currency, the United States had to run deficits, supplying dollars to the world. But running deficits undermined confidence in the dollar's gold convertibility. The system contained its own destruction. Wall Street ignored this. Economists dismissed Triffin as a pessimist. The Federal Reserve insisted they had everything under control. At investment banks throughout Manhattan, gold remained a punchline. Analysts joked about gold bugs hiding coins under mattresses. Portfolio managers bragged about zero precious metals exposure. Financial advisors who mentioned gold to clients were accused of fear-mongering. The contempt was total, the confidence was absolute, and beneath the surface, the mathematics of collapse were already in motion. Act 2. The system begins to crack, 1965-1970. The numbers don't add up. The Treasury Department basement vault, March 1965. Junior economist Paul Volcker reviews the latest gold flow data with growing alarm. The numbers don't match the official narrative. In the first quarter of 1965 alone, the United States has shipped 370 tons of gold to foreign central banks demanding conversion. At this rate, Fort Knox will be empty in 7 years. Volcker carries his analysis upstairs to his superiors. Their response is immediate. Classify it. Undersecretary Frederick Deming is blunt. Paul, this information cannot become public. If markets understood the drain rate, they'd accelerate redemptions. We'd face a run. The United States was trapped in a slow-motion bank run, and the bank was Fort Knox. The crisis had multiple causes, each reinforcing the others. First, Vietnam. The war was costing $2 billion monthly by 1967, rising to $3 billion by 1969. President Johnson had promised both guns and butter, war abroad and great society programs at home. The federal budget deficit exploded from $1.4 billion in 1965 to $25 billion by 1968. Second, the Great Society, Medicare, Medicaid, urban development, education spending. Lyndon Johnson's domestic agenda cost $200 billion between 1965 and 1970. Well-intentioned, poorly financed, It required printing money the gold reserves couldn't support. Third, trade erosion. The U.S. trade surplus vanished. American exports faced rising competition from rebuilt European and Japanese industries. By 1968, the trade balance had swung negative for the first time in the century. The mathematics were brutal. The federal government was spending $180 billion annually, with revenues of $155 billion. The difference was printed, borrowed, or extracted from gold reserves. Foreign central banks watched with growing suspicion. Charles de Gaulle, President of France, understood the game perfectly. In February 1965, he gave a press conference that sent shockwaves through Washington. "The United States enjoys an exorbitant privilege," de Gaulle announced. "They print paper. We produce goods. They trade paper for our goods, and we accumulate paper claims. This is not sustainable. France will begin converting dollar reserves to gold immediately." Within months, France had redeemed $750 million in gold from Fort Knox. Other nations watched carefully. If France was redeeming, perhaps they should too. The Bank of England, managing the London Gold Pool, a consortium of central banks committed to defending the $35 gold price, began reporting unsustainable intervention. Private buyers were purchasing gold faster than the pool could supply it. In November 1967, the British pound collapsed, devalued 14% overnight. If Britain couldn't maintain its currency, how long could the dollar hold? Speculators began testing the system. Private buyers purchased gold in London, betting the $35 peg would break. The London Gold Pool sold thousands of tons to defend the price. The drain accelerated. Treasury Secretary Henry Fowler called an emergency meeting in December 1967. The classified briefing laid out the crisis in stark terms. U.S. gold reserves down to 12,065 tons. Foreign dollar claims, $35 billion, requiring 30,000 tons of gold to cover at $35. Coverage ratio, 40% and falling. Monthly gold outflow, 100-200 tons. Time until crisis, 18 to 36 months maximum. "Gentlemen," Fowler told the room, "we are facing the monetary equivalent of a run on a bank. If this accelerates, if multiple countries demand conversion simultaneously, we cannot meet the claims. The Bretton Woods system will collapse." On Wall Street, the official message remained confident. The dollar was sound. Gold was irrelevant. Anyone suggesting otherwise was labeled a crank. But privately, some institutions were hedging. The Rothschild banking family quietly accumulated gold through European dealers. Swiss banks increased precious metals inventory. German Bundesbank officials privately warned their American counterparts, "You must stop the inflation. We cannot hold dollars that lose purchasing power." By March 1968, the London Gold Pool faced catastrophe. Private buyers were demanding 200 tons daily, far beyond what central banks could supply without depleting their reserves completely. On March 14, 1968, the pool collapsed. Central banks announced they would no longer supply gold to private markets. A two-tier system emerged. Official gold transactions remained at $35, but private market gold was allowed to float. Within weeks, private gold prices jumped to $44 per ounce. The $35 peg had broken partially. Full collapse was only a matter of time. Paul Volcker, now a senior Treasury official, circulated an internal memo in April 1968 that was marked secret and locked in safes. The United States faces a choice. We can defend the dollar by raising interest rates dramatically, cutting spending severely, and accepting recession. Or we can abandon gold convertibility and accept the inflationary consequences. There is no middle path. The current policy, defending the dollar with verbal assurances while printing money, cannot continue. We are living on borrowed time measured in months, not years. President Johnson, exhausted by Vietnam and domestic unrest, chose to kick the crisis to his successor. In March 1968, he announced he wouldn't seek re-election. Richard Nixon inherited a monetary time bomb. By January 1970, the numbers had deteriorated beyond repair. U.S. gold reserves, 9,138 tons, down 50% since 1960. Foreign dollar claims, $47 billion, requiring 40,000 tons to cover. Coverage ratio, 24%. The United States could cover less than 1/4 of its obligations. Wall Street continued selling equities and bonds, dismissing gold as irrelevant. But in Zurich, in Frankfurt, in Paris, central bankers were making quiet calculations. If the United States couldn't defend $35 gold, what would happen when the system broke? German officials privately estimated gold would reach $100 within months of any dollar devaluation. Swiss bankers thought $200 was possible. French economists whispered $300. On Wall Street, these estimates were dismissed as fantasy. Gold at $100? Impossible. The asset generated no yield. Modern portfolio theory proved diversification into unproductive assets was irrational. The financial establishment had built careers on dollar stability. To admit gold might explode would be to admit they'd been wrong for decades. Ego and institutional inertia prevented honest assessment. But the mathematics didn't care about ego. By August 1971, the crisis could no longer be denied. Act 3. The run on U.S. gold. Foreign governments call the bluff. The Federal Reserve Bank of New York, August 5, 1971. The gold vault, 4 stories below street level, hummed with activity. Fork lifts moved 400-ounce bars from American storage cages to foreign compartments. Each bar represented $14,000 at official prices, and rising market value in Zurich. Britain had just demanded $3 billion in gold conversion. France wanted another $750 million. Switzerland, always pragmatic, requested $50 million weekly on a standing order. The vault manager, a 30-year Fed veteran, watched the bars disappear and understood what his superiors wouldn't admit. They were losing control. The crisis had escalated beyond management. In May 1971, Germany and Austria had allowed their currencies to float, refusing to continue importing American inflation. The Bundesbank had purchased $2 billion, defending the fixed exchange rate in a single week. German officials told their American counterparts bluntly, "We will not sacrifice German price stability to maintain your monetary system." Japan faced similar pressure. The Bank of Japan was accumulating dollars at unsustainable rates, creating domestic inflation. Japanese officials privately requested that the United States reduce its deficits. American Treasury Secretary John Connally responded with characteristic bluntness. "The dollar is our currency, but it's your problem." This arrogance masked desperation. Throughout June and July 1971, European central banks escalated their gold redemptions. The outflow from Fort Knox and the New York Fed vaults reached 100 tons weekly. At that pace, convertible reserves would be exhausted by year-end. Speculators recognized the endgame. Currency traders began shorting the dollar, betting on devaluation. Gold prices in private markets climbed to $43, then $44, moving further from the official $35 peg. On August 6, 1971, a congressional subcommittee released a report titled The Decline of U.S. Gold Reserves. The document, meant to be technical, was devastating. Gold reserves had fallen 55% since 1960. Foreign claims exceeded U.S. gold by 400%. Current redemption rates would exhaust reserves in 6 months. The United States, the report concluded, can no longer meet its Bretton Woods obligations. Convertibility must end, or gold reserves will be completely depleted. Financial markets reacted immediately. The dollar plunged in European trading. Gold spiked to $44.60 in Zurich. Speculative flows intensified. At the Treasury Department, Secretary Connally convened emergency meetings with Federal Reserve Chairman Arthur Burns and White House Economic Advisor George Shultz. The consensus was grim. They'd lost control. Burns argued for dramatic interest rate increases to defend the dollar, perhaps to 10% or higher. Connally rejected this as politically impossible. Nixon faced re-election in 1972. Recession induced by rate hikes would be suicidal. Schultz proposed the inevitable: close the gold window, end convertibility, let the dollar float. The consequences, Burns warned, will be catastrophic. Inflation, currency chaos, loss of American credibility. We're proposing to default on our obligations. We're already in default, Connally shot back. We just haven't admitted it yet. We can announce it now on our terms, or wait until foreign governments force our hand. I prefer the former. On August 12th, with currency markets in chaos and gold outflows accelerating, Nixon made his decision. He would announce the end of dollar-gold convertibility in 3 days, before markets opened Monday. The decision was made in secrecy at Camp David. Nixon invited key advisors: Connally, Schultz, Burns, Volcker, and economic advisors. No congressional leaders, no foreign allies. The announcement would blindside the world. Wall Street remained oblivious. Friday, August 13th. Trading saw normal volumes. Equity analysts published reports assuming continued dollar stability. Gold dealers reported quiet markets. None suspected that in 72 hours the monetary system would shatter. ACT4. The Nixon Shock. August 15th, 1971. The night the dollar died. Sunday evening, August 15th, 1971. 9 p.m. Eastern Time. Richard Nixon appeared on national television, interrupting bonanza, reaching 100 million Americans with words that would end the post-war monetary order. I have directed Secretary Connally to suspend, temporarily, the convertibility of the dollar into gold or other reserve assets, except in amounts and conditions determined to be in the interest of monetary stability and in the best interests of the United States. Suspend temporarily. The phrase was Orwellian. The suspension would become permanent. The dollar would never return to gold. Nixon framed it as defending America against speculators. International money speculators have been waging an all-out war on the American dollar. I have instructed Secretary Connally to defend the dollar against these attacks. The reality was simpler. The United States had printed more paper than it had gold to redeem, and foreign governments had called the bluff. The announcement included other measures: wage and price controls, import surcharges, spending cuts, but they were theatrical. The core message was unmistakable. America was abandoning gold. In Zurich, where Monday had already begun, gold dealers watched the news on shortwave radio. By dawn, their phone lines were overwhelmed. Everyone wanted gold. No one wanted dollars. The price exploded, $44 to $50 in hours. By week's end, $65. Gold, the barbaric relic mocked by Wall Street, was suddenly soaring while the dollar collapsed. Foreign governments reacted with shock and fury. British Chancellor of the Exchequer, Anthony Barber, called it a betrayal of international obligations. The French finance minister labelled it economic warfare. German officials issued statements expressing deep concern about American monetary policy. But privately, European bankers felt vindicated. They had suspected for years that American promises were worthless. Now they had proof. Japanese officials were most shocked. Japan held $12 billion in dollar reserves, suddenly devalued overnight without consultation. The betrayal would reshape Japanese monetary policy for decades. Nixon's Treasury Secretary John Connally met with European finance ministers in September 1971 in London. The meetings were hostile. European officials demanded compensation for their losses. Connally's response became infamous. "The dollar is our currency, but it's your problem." Wall Street's reaction revealed institutional denial. On Monday, August 16th, the Dow Jones fell 2.3%, a significant decline but not catastrophic. Analysts issued statements calling the Nixon shock a temporary disruption that would strengthen the dollar long term. Major brokerage houses recommended staying invested in equities and bonds. Gold was still dismissed as a non-productive asset that would return to normal once speculation subsided. Morgan Stanley's chief economist told clients, "Gold will settle around $40–45 once the panic ends. The fundamentals haven't changed. Gold generates no yield." This analysis would age like milk in the desert sun. By October 1971, gold traded at $65. By December, $70. The old $35 peg was dead, but Wall Street still believed normalcy would return. What they didn't understand was that Nixon had released inflation from its cage. Without gold discipline, without convertibility requirements, the United States could print unlimited dollars. And it would. The Federal Reserve, freed from gold constraints, began expanding the money supply at unprecedented rates. M2 money supply growth accelerated, 10% in 1971, 13% in 1972. The influx of dollars flooded the economy. Consumer prices, stable for decades at 1 to 2% annual increases, began climbing, 3.3% in 1971, 4.3% in 1972. This was just the beginning. Paul Volcker, the architect of the Nixon shock's implementation, privately expressed regret years later. "We thought we could manage a fiat currency responsibly. We were wrong. The temptation to print proved too strong for politicians. We unleashed something we couldn't control." The Nixon shock represented a fundamental break in monetary history. For the first time since civilization began, major currencies would have no anchor to physical commodities. Paper money backed by government promises, and nothing else. The consequences would devastate the 1970s. Act 5. The dollar spirals out of control, 1971–1974. Money loses meaning. The Kroger Supermarket, Columbus, Ohio, June 1973. Margaret Henderson, a 63-year-old widow living on Social Security, stands in the checkout line with $40 in her purse, her weekly grocery budget. She watches prices scroll across the register with growing panic. Ground beef, $1.29 per pound. Last month, 0.89s. White bread, 0.45 per loaf. Last month, 0.32. Milk, 1.15 per gallon. Last month, 0.88. Her cart total, 47.60. She doesn't have enough. She tells the cashier to remove items until the total hits 39.50. Walking to her car, she cries. Margaret had saved carefully her entire life. Her late husband's insurance policy and her Social Security were supposed to last. Now money was vanishing while she held it. Stories like Margaret's multiplied across America in the early 1970s. The inflation unleashed by the Nixon shock moved from abstract statistics to lived catastrophe. The Consumer Price Index told the story. 1971, plus 4.3%. 1972, plus 3.3%. 1973, plus 6.2%. 1974, plus 11.1%. 1975, plus 9.1%. But these national averages disguised regional spikes and category explosions. Food prices jumped 20% in 1973 alone. Energy costs doubled. Housing costs soared. Americans who had lived through decades of price stability watched their purchasing power disintegrate in real time. The causes were multiple and interconnected. First, pure monetary expansion. The Federal Reserve, freed from gold constraints, expanded the money supply at rates not seen since the Civil War. M2 grew 40% between 1971 and 1974. Second, oil shocks. OPEC, emboldened by dollar weakness, quadrupled oil prices in 1973 to 74. Gasoline jumped from 0.36 to 0.55 per gallon, then to 0.86. Americans waited in 2-hour lines at gas stations. Third, psychological collapse. Once inflation expectations became embedded, they became self-fulfilling. Workers demanded higher wages. Businesses raised prices preemptively. Lenders increased interest rates. The spiral fed itself. By 1974, America faced stagflation. Rising prices combined with economic stagnation. Unemployment hit 9%. GDP growth turned negative. The misery index, unemployment plus inflation, reached 19%, highest since the Great Depression. Traditional economic theory couldn't explain it. Keynesian models assumed inflation and unemployment moved inversely, but both were rising simultaneously. The dollar's value internationally collapsed faster than domestic prices suggested. Against the German Deutsche Mark, 365 in 1971 to 240 in 1974, a 34% decline. Against the Swiss franc, 430 to 245, a 43% decline. Against the Japanese yen, 360 to 280, a 22% decline. Foreign holders of dollar assets watched their wealth evaporate. German savers who had held US bonds lost 40% in real terms. Japanese pension funds faced catastrophic losses. And gold, the barbaric relic, the dead asset, the useless metal mocked by Wall Street, exploded. $35 in August 1971, $65 by January 1972, $97 by July 1973, $180 by December 1974. A 400% increase in 3 years. Gold, which generated no yield, was dramatically outperforming every traditional asset class. Stocks fell. The Dow Jones dropped from 1,051 in 1973 to 577 in 1974, a 45% collapse. Bonds got crushed. Fixed income investors lost 30% of purchasing power as inflation devoured coupon payments. Real estate became unaffordable as mortgage rates climbed from 7% to 11%. Only gold rose. Only gold protected savings. Only gold maintained purchasing power. Americans began to understand what their grandparents had known during previous currency collapses. When government money fails, people turn to metal. In 1974, President Ford legalized private gold ownership for the first time since 1933. The ban had lasted 41 years. Within months, Americans were lining up at coin dealers to convert paper into metal. The U.S. Mint began producing gold coins. Private mints created gold medallions. Jewelry stores reported surging demand for 24-carat pieces purchased explicitly as savings vehicles. Margaret Henderson, the widow from Ohio, learned about gold from a neighbor. She began buying 1/10-ounce gold pieces every month, whatever she could afford. "I don't trust dollars anymore," she told her daughter. "Gold doesn't lie." The psychological shift was profound. For the first time since World War II, Americans doubted the fundamental stability of their currency. Surveys from 1974 showed 67% of Americans believed inflation would get worse. 54% believed the dollar would continue losing value. 43% had reduced savings because holding cash felt pointless. This collapse of monetary trust would define the decade. Act 6. The 1970s inflation explosion. The decade of despair. The Oval Office, October 1978. President Jimmy Carter reviews inflation data with advisors. The numbers are worse than anyone predicted. Consumer Price Index, 9.0% annually and accelerating. Mortgage rates, 10.5% and rising. Prime lending rate, 11.75%. Gold price, $220 and climbing. How did we lose control? Carter asks. Treasury Secretary Michael Blumenthal answers with brutal honesty. We never had control, Mr. President. We've been printing money faster than the economy grows for 8 years. The bill is coming due. The 1970s became the decade of monetary destruction. What began with the Nixon shock in 1971 culminated in the most severe peacetime inflation in American history. The statistics tell a story of systemic failure. Inflation rates, 1976, 5.7%, 1977, 6.5%, 1978, 7.6%, 1979, 11.3%, 1980, 13.5%. Compounded over the decade, the dollar lost 60% of its purchasing power. A dollar in 1971 bought 40 cents worth of goods by 1980. For Americans on fixed incomes, retirees, pensioners, savers, it was catastrophic. The wage price spiral became unstoppable. Unions demanded 10 to 15% annual raises. Businesses raised prices to cover increased labor costs. Workers demanded more raises. The cycle fed itself. In 1979, truck drivers struck for 30% wage increases. Miners demanded 37%. Auto workers got 23%. And prices jumped accordingly. Interest rates climbed in a desperate attempt to slow inflation. The Federal Reserve, under Chairman G. William Miller, raised rates repeatedly. But inflation kept accelerating faster than rates could rise. Mortgage rates hit 12% in 1979. Home sales collapsed. Construction stopped. But housing prices kept climbing, 7% annually, because the dollar was falling faster than rates could choke off demand. The stock market became a casino where everyone lost. The Dow Jones oscillated wildly, down 30% one year, up 20% the next. But in real inflation-adjusted terms, equities lost 50% of value during the decade. Bonds were slaughtered. Fixed-income investors faced losses exceeding the Great Depression. A 30-year Treasury bond purchased in 1970, yielding 6%, lost 70% of real value by 1980. Traditional financial planning collapsed. The assumption that bonds were safe, that stocks grew with the economy, that saving money built wealth, all failed. People stopped saving. Why save dollars that lost 13% of value annually? Savings rates, typically 10% of income, fell to 5%, then 3%. Consumer behavior changed fundamentally. Americans bought immediately because prices would be higher tomorrow. Credit card debt exploded. The idea of delayed gratification became irrational when money constantly depreciated. The gold price reflected this monetary chaos. 1976, 125, 1977, 148, 1978, 193, 1979, 512, 1980, $850 from $35 in 1971 to $850 in 1980, a tiny 329% increase. Gold dealers couldn't keep inventory. The U.S. Mint's gold coins sold out within hours of release. Private mints worked 24-hour shifts producing gold medallions. Coin shops reported lines around the block. People brought paychecks, life savings, inheritance money, anything they could convert to metal. In Southern California, a coin dealer named Jim Sinclair watched customers liquidate every paper asset to buy gold. They came in with stock certificates, bonds, insurance policies. They wanted gold. An elderly woman brought her wedding ring collection, not to sell the old rings, but to buy new gold coins. She said, "My dollars are dying. At least gold lives." Foreign central banks made the same calculation. Germany increased gold reserves. France bought heavily. Switzerland, already holding substantial gold, increased holdings further. The dollar became international poison. Oil-producing nations demanded alternative payment methods. Some deals were settled in Deutsche Marks, others in Swiss francs. Gold itself became a settlement currency. By 1979, OPEC was openly discussing pricing oil in gold rather than dollars. The ultimate humiliation, the world's reserve currency rejected by the market, it had dominated for 30 years. President Carter, facing re-election in 1980, recognized the crisis required drastic action. In July 1979, he appointed Paul Volcker as Federal Reserve Chairman with a single mandate: break inflation regardless of cost. Volcker understood what was required. Interest rate increases so severe they would induce recession. Economic pain so intense it would shatter inflation psychology. In October 1979, Volcker raised the federal funds rate to 15%, then 17%. By 1980, 20%, the highest interest rates in American history. The economic consequences were immediate and brutal. Unemployment jumped from 6% to 11%. GDP shrank 2.5% in 2 quarters. Businesses failed by the thousands. The housing market died completely. Who could afford a 16% mortgage? But inflation began to break. Slowly, painfully, the wage price spiral slowed. By 1982, inflation had fallen to 6%. By 1983, 3.2%. The cost was the worst recession since the Depression. But the alternative, continuing inflation that destroyed money itself, was worse. Gold peaked at $850 in January 1980. Then began a long decline as Volcker's interest rates made dollar-denominated assets competitive again. By 1982, gold had fallen to $300. The gold bugs who had bought at the peak lost fortunes. But those who had bought in 1971, 1974, those who had purchased when Wall Street was still laughing, had made 10-to-1 returns or better. The 1970s taught a lesson Wall Street had forgotten. When governments destroy money, hard assets protect wealth. Act 7. Gold's Revenge. The barbaric relic strikes back. The trading floor of Salomon Brothers, January 21st, 1980. Gold has just hit $850 per ounce. $850. The metal that was dead at $35 9 years ago has exploded 2,329%. Traders who mocked gold bugs for a decade watch in stunned silence as clients demand precious metals exposure. The phone lines glow with panicked requests. "Get me gold, any gold now." One senior partner mutters to his colleague, "We told them gold was worthless. We told them paper was king. We were wrong about everything." The great reversal was complete. Wall Street firms that had banned gold from model portfolios were now scrambling to acquire bullion for clients. Investment banks that published research papers declaring gold irrelevant were now hosting gold strategy conferences. Financial advisors who had dismissed gold bugs as cranks were now calling those same individuals begging for guidance. The irony was exquisite. From 1971 to 1980, while Wall Street recommended stocks and bonds, gold had outperformed every conventional asset by enormous margins. Gold plus 2,329%, Dow Jones 17%, inflation-adjusted 60%, 10-year Treasury bonds 33%, inflation-adjusted 68%, dollar purchasing power 60%. The greatest bull market in gold history had occurred while the financial establishment insisted it was impossible. The humans who benefited were those Wall Street had mocked. Small-town coin dealers who stacked silver and gold through the 1970s became millionaires. Middle-class families who bought Krugerrands instead of savings bonds retired comfortably. The cranks had been right. The experts had been catastrophically wrong. In Los Angeles, a plumber named Robert Chen had started buying 1-ounce gold coins in 1972 when they cost $65. His financial advisor had ridiculed him. "You're wasting money on shiny rocks that generate no return." By 1980, Chen's gold collection was worth 13 times his initial investment. His stock portfolio, recommended by that same advisor, had lost 40% in inflation-adjusted terms. "I didn't buy gold because I was smart," Chen told a reporter in 1980. "I bought it because I didn't trust the government. Turns out that was smart enough." Stories like Chen's multiplied across America. Ordinary people who had sensed something wrong with unlimited money printing, who had trusted metal over promises, had protected their families' wealth, while Wall Street professionals lost fortunes. The lines outside coin dealers in 1979-1980 stretched around blocks. In Manhattan, in Chicago, in Houston, in Phoenix, anywhere gold was sold, crowds gathered. Dealers rationed coins, 1 per customer, 2-hour waits, premiums of 20–40% over spot price. Supply couldn't meet demand. The U.S. Mint's Gold Medallion program, launched in 1979, sold out instantly. The Mint received 500,000 orders for 100,000 available pieces. Lotteries were held to determine who could buy. South African Krugerrands, the most popular gold coin, traded at premiums reaching 50%. A 1-ounce Krugerrand with $850 worth of gold sold for $1,200. Buyers paid $350 extra just to obtain physical metal. Canadian maple leafs commanded similar premiums. Mexican pesos, Austrian philharmonics, any gold coin became precious. People weren't buying gold to trade it, they were buying gold to keep it. The psychology had shifted fundamentally. Americans had learned that paper promises were contingent. Government assurances were temporary. Only metal was permanent. Central banks made the same calculation. After years of selling gold, reserves, assuming dollars were superior, they reversed course. By 1980, central bank gold sales had stopped completely. Many began buying again. The Bank of England, which had sold gold at $35 in 1968 to defend the dollar, watched gold hit $850 and understood the magnitude of their error. They had sold 1,000 tons at $35, worth $1.2 billion. That same gold was now worth $27 billion. The French, who had demanded gold conversion in 1965 under de Gaulle, looked prescient. France had increased gold reserves from 1,000 tons to 2,500 tons between 1965 and 1968, at an average price of $35 per ounce. By 1980, that gold had generated a 2,300% return. Germany, Switzerland, and Italy, all of which maintained substantial gold reserves, saw their national wealth explode. Countries that had trusted dollars, like Japan, faced devastating losses. The geopolitical implications were profound. Gold-holding nations gained power. Dollar-holding nations lost power. The monetary order had inverted. Wall Street's institutional memory was short, but the lesson was clear. Hard assets trump paper promises when governments lose discipline. By 1981, with Volcker's interest rate shock-breaking inflation, gold began its long decline from the $850 peak, but it never returned to $35. It never went back to barbaric relic status. The floor was established. Gold had proven itself as the ultimate monetary insurance. When paper burned, metal endured.